Welcome back to another Meet Kevin report. We are on episode 127, July 20th. Remember, there is a link in the description for a newsletter, daily newsletter. We're getting a lot of phenomenal feedback from. Want to pitch it to you, especially since it's totally free and insights coming from me and the team. Super fun. So we've got the 10-year bouncing back a little bit to 379. We're trying to get that 10-year down to some extent, start decreasing that cost of borrowing, especially since that directly relates to what we heard Elon rant about yesterday in the earnings call. Although he's regularly ranted about this, made it very clear when asked about potential for future rate or price decreases that the biggest thing that Tesla would react to is obviously not only demand, but what rates do. And so rates have kind of been trending up until about 2 weeks ago. And they started trending down again, at least on the 10-year. And the 10-year tends to be this sort of guide for where other rates are going, whether it's mortgage rates or vehicle rates. So we'll see. So far, over the last couple weeks here, I'd say we've been trending off of that 4% peak that we hit, probably maybe about a week and a half. You can see that here, if we pull it up like this, you've got that nice 10-year chart. Off that peak again. We rarely sit above that 4% level long. We saw a hitting 4% here in November, October, November, briefly hit it again in March, briefly hit it again here in July. Really difficult to keep these rates above 4%. Though it does feel like they've firmed up quite a bit here on the right side, closer to those high 3%. Higher rates for longer, obviously more pressure on not only vehicles, but also real estate and other business investments. You look at Taiwan Semi, for example, this morning arguing that, hey, we still have a worker shortage out here in Arizona, and we're going to delay the launch of our plant from the fourth quarter of 2024 to 2025. Of course, most headlines are just saying it's 2024 to 2025, which makes it seem like it's a whole years of a delay. But either way you slice it, it is a delay before they'll actually get production off the ground. So let's take a look at American Airlines and some of the earnings numbers that we're getting this morning. We'll look at TSM as well to get a little bit more color and see what we've got from our good old earnings, especially after Tesla yesterday. So when it comes to American Airlines, this morning, American reported airlines somewhat decent, I suppose. But let's go through some of the actual numbers. And we'll add some commentary as well in a bit on Netflix. So what did we get for American Airlines? Let's see here. American Airlines Q3 capacity up 5 to 7%. American Airlines, let's see, says it will match higher United pilot wages. Still getting that wage jump on pilots. It's incredible. That's one space that really, if you're looking for shortages and inflation, it's aerospace. You see that over at Boeing or Lockheed or Embraer, the airlines, doesn't matter. They're all complaining about supply chain shortages, inflation. They're all complaining about the same thing. American Airlines available seat miles, 69.7 versus 69.1. Adjusted EPS for Q3 forecast is estimated to be 90 cents, and the forecast was 90 cents. Your American Airlines Q2 passenger revenue comes in at a beat, 12.9 versus 12.59 billion. Adjusted EPS 1.92 versus 1.59. So you got a beat on the bottom, match on the forecast, beat on the top. Load factor comes in a little bit higher than expected, 86.2 versus 85.7%. And let's see here. We have fiscal year operating margins to be about 8 to 10%, somewhat a long expectation. So the stock initially moved up, but doesn't seem to be moving too terribly much right now, probably because the earnings are relatively benign. But that's almost what you want at this stage of the economy. You kind of don't want any big, massive surprise in almost either direction. Just, hey, everything going along good as usual would be nice to see. We did get J&J reporting as well, and they can tend to be a good little insight into inflation when we look at their earnings calls. Their earnings calls take a little longer to come out, but let's take a look at some of their actual headlines. So robust guide and demand for second quarter. Let's see here. Operating sales forecast for the year to be a little hotter than expected, about 99.7 at the midpoint versus the expectations of around 98.4-ish. Let's see. MedTech beats 779 versus a 759 billion expected. Pharma sales beat 13.37 versus 13.19. Sales across the board beat 25.5 versus 24.67. EPS comes in at 280 versus 262. And so Johnson & Johnson up about 1% here after boosting their full year profitability just a tad. So these give us some little insights into some of the earnings following the Tesla and Netflix yesterday. Tesla, obviously, a lot of folks somewhat frustrated about Elon's performance during the earnings call, since the stock seemed to be just fine during the actual earnings report, but not so great during the call. Some folks thinking he was unprepared and distracted. Some folks thinking he was being realistic, discussing that, look, if rates stay higher for longer, we'll adjust demand as we need to. And maybe a little less Cybertruck optimism than folks were hoping for. D.R. Horton, your home builder, comes in with a $3.90 EPS versus the estimate of $2.83. Those builder profits are just killing it. Q3 revenue, $9.73 billion. Estimate was $8.3. Fiscal year revenue expected to sit somewhere around $34.9 billion. That's way up from the previous estimate of about 32.7. Wow. Also closed way more homes than expected, about almost 4,000 to 5,000 more homes than expected at or for the year. That's the expectation, their forecast they're giving, expecting a lot more homes. Putting them somewhere right around 83,000 homes versus the previous guidance of closer to 78. It's a good 5,000 more than expected. D.R. Horton jumped, initially 7.9% on this. I wonder how they're holding up now. D.R. Horton up right now 4.5%. So had a nice little bump there, softened just a tad, but almost the exact opposite of that 4% decline you're getting over there at Tesla. 2% decline over at Enphase. That Tesla earnings call wasn't the most optimistic for solar as well, especially with the complaints about rates really leading to softness in solar, which we saw in the actual earnings report as well. All right, very well. So that gives us a bit of an intro. Now we're going to get into some commentary on retail spend. So we'll call this earnings intro. All right, retail spend. Alrighty, so let's see here. Initially, when we got the June retail sales data, we had a lot of optimism that, hey, the consumer was holding up and that maybe that would continue to prop our economy up. Well, the good old bears over at TS Lombard actually don't think it's the greatest news for inflation. Let's take a look at their latest piece just released here on June retail spending for the Fed. Good news, but bad on inflation. And once again, they're suggesting that the Fed is not going to be able to pull off a soft landing. What do they have to say? They say June's retail sales data was essentially a mixed bag. TS Lombard suggests that real discretionary retail sales dropped 0.1% in the quarter. And this really sets up for weaker quarter-on-quarter growth in the final sales read for Q2 versus Q1. On top of that, non-energy production ex high tech dropped 0.3% in June, second monthly decline, down 0.6% year over year. All this plus CPI data should bolster the Fed's sense that July's hike may very well be the last. Now, I find it interesting. Bulls and bears are somewhat agreeing on this, that, hey, we're probably only going to get one more Fed rate hike, and then we're going to be done, which is great, but is it? Because if it's a sign that you're getting enough weakening, then how is that really going to translate to earnings? Well, right now, when we look at the chance of a 25 basis point hike, I don't think I've seen it sit any higher than this. Last night, it sat at 99.2%, and the current probability sits at 98%. Today's obviously Thursday. The next Fed meeting is on Wednesday, the 26th. That aligns with coupon code expiration day. That's going to be a big one. Link down below. But anyway, that's the 26th. That's in Wednesday. That's in 6 days. And we're basically now sitting at a 98 to 99% probability of getting that 25 BP hike. And then thereafter, for the September meeting, we're at an 82.6% chance of sitting at the same spot, somewhat agreeing here with that last hike for July. But consumer patterns here, says T.S. Lombard, have shifted to the upside and seem set to stay that way absent a recessionary rise in unemployment. This is the other thing a lot of economists are freaking out about is how do we not have more unemployment? It seems remarkable that unemployment data continues to be so strong, because really you need unemployment to start before you actually end up weakening the economy. We actually did just about 30 seconds ago get initial jobless claims. Initial jobless claims were expected to come in at 240,000 along this note. They actually missed, coming in at 228. So in other words, better than expected, less joblessness than expected. So I guess you could call that a beat, but it depends on kind of which way you look at the numbers. Continuing claims did come in a little hotter than expected. We were looking for 1.722 and we got 1.754. So that was partially offset by a downward revision for the last continuing claims read. Again, no big rollover here on claims or job numbers. Again, somewhat reiterating what T.S. Lombard is saying here, that doesn't seem like we're going to get that recessionary unemployment rise. Now, looking at dollars rather than the percent changes here, retail spending at apparel stores have been falling and are flat to drifting lower for eating out. Real declines in spending in these categories are often the precursor to a recession. There was also a drop in gasoline spending, even though gas prices increased. Against these negatives, real spending at broad category retailers accelerated. So in other words, they're really talking about this disparity of what, ordinarily when you're getting these either flat reads or declines, you might be signaling a recession, but it's frankly jobs that are masking this fear of recession. Broad inflation trends tend to track discretionary retail spending as a percentage of income, although spending is hardly the only determinant of inflation. Blah, blah, blah. Kind of a little bit more background here onto the 90s. So here is the suggestion of a deflationary trend. I mean, geez, when you look at discretionary retail as a percentage of personal income spending, you have a decline that's somewhat starting to align with what you're actually seeing in CPI. It almost makes you wonder if the red line here is CPI and the blue line here is retail spending. Is it possible that retail spending essentially just matches CPI? Or in other words, as the dollar value of prices fall, people aren't necessarily spending more, which you might think, right? Prices down, people spend more. No, people just spend less. So you get this ultimate match of CPI with sales, which leads to less overall GDP and therefore potentially a recession, is the theory here that T.S. Lombard is arguing. In other words, look beyond the near-term recession risk and the longer-run inflation question, and where spending eventually settles will be critical. Spending rates historically move inverse to liquidity because here's that liquidity argument again, man. Because liquidity levels are driven by household behavior. In the current cycle, it was the government and the Fed boosting consumer liquidity and high employment in response, shooting up the amount of spending households were doing. However, spending and liquidity ratios will resolve themselves down in the coming months, or at least likely return to the spending we've seen between 2012 and 2019, where there was a focus on reducing debt relative to income. So, in other words, what about household liquidity? Maybe we don't only need to consider Fed liquidity, which that was somewhat overblown. I think I've heard this idea that, oh no, the Treasury General account needs to be refilled and therefore we're going to have a liquidity crisis. I think we've heard this idea about 37 different times. And every single time we go, well, if there's a liquidity problem, you just have to look at the repos, which is basically this almost, I like to think of it as sort of like an expansion tank on your water heater. So when there's more pressure on the water lines, your expansion tank expands, and when there's less, it shrinks. And that's somewhat what the reverse repo is. It's kind of like, oh, need more place to put money? Put it into here. The repos go up. Now you need that extra capital. Oh, it's shrinking. And look at what's basically exactly what's happening. Reverse repos actually falling at a pretty nice pace over here, sitting at only $1.73 trillion in the only 1.73, but sitting at 1.73 trillion in the reverse repos market here, indicative that any of the liquidity issues we have had potentially or would have had have been absorbed almost by the reverse repo facility completely. So now TS Lombard, probably realizing this, is saying, well, don't just worry about Fed liquidity. Consider individual liquidity. All right, okay. Let's take a look here. Okay, one further indication. Ooh, here we go. One further indication that spending is not going to meaningfully drop relative to income anytime soon is the index of aggregate weekly payrolls has caught up to discretionary spending. In other words, until employment turns down, spending potentially continues to grow. So in other words, we have this little translation here. So if we continue to get these robust claims, maybe spending can hold up. Okay, so the recession call here from TS Lombard is rooted in tech and finance. Okay, interesting. Signs of a slowdown abound, and speaking like Shakespeare here, and real final sales in Q2, Q1 should confirm this. But the question of whether this will be enough to kick off a recession, given the massive overhang of household liquidity, remains unresolved. My base case is still a mild recession, but so too is my longer view. The markets and Fed's confidence in a benign return to 2% inflation is misplaced. Yeah, kind of a weak bear piece here. I mean, to some extent, I feel like we got a bear piece that's like, look, spending declining is going to drive us into a recession, sort of this pounding the fist on the table, and then sort of hedging that by saying, but then again, people are still able to get jobs and maybe that'll keep spending up. But I still think the Fed's 2% target is unrealistic. That kind of feels like what they just said here, and it doesn't feel that convincing. Let's take a listen to CNBC to see if they've got something better to say.
Only first thing. Ladies and gentlemen, it's a poll of 1,000 people around the country of all places. Just
all America.
No. We don't happen to be athletes.
No, all America.
No, they don't. They've got the music playing. I feel like every time this morning I've been pouncing over them. Even before this stream, they've been playing the music. So they're so quiet. All right, we'll try Bloomberg.
Fed is raising rates. What shouldn't we see claims be going up?
You can see some signals here and there that looking a little easier, but wage inflation has peaked. It may be coming down, but it's still 5% plus. It needs to get down to 3% to be consistent with the Fed's target of 2% inflation, given 1% productivity.
This is the best argument the Bears have. Is, well, yeah, inflation is falling, but it's not fast. It's not at the target yet. Still not there yet. It's like so annoying. It's almost feels like you're like, let's say you were handicapped because you got in a car accident or something horrible. Knock on wood that doesn't happen. But then it's like, all right, now you got to run the mile. And you just started running the mile. You got out of the wheelchair and you're running the mile. And you're like doing it. You're doing well. You're like, wow, people are looking at you going, dang, you know what? They're going to pull this off. They're running the mile. This is great. Wheelchair to mile. And then you got the grumps on the side that are like, yeah, he hasn't made it yet. He could fall. It's so annoying.
In manufacturing challenges. What's the Deutsche Bank view of how this war affects the European economy out 12 months, out 24 months?
Our view is that the war is going to persist, will be a background, obviously a foreground factor in terms of on the geopolitical side. On the economic side, our expectation is that the slowing that we've seen from energy price increases has not been as severe as was feared. But at this point, the economy is still pretty hot in terms of labor markets. Inflation is too high, and I think the bigger driving factor is what the ECB does. Our thought is one more and done for the ECB as well, but that's going to be slowing things with the war in the background as a factor. Right. Looking beyond the next 12 months, as you say, there's a lot of investment to come along.
But in core Europe, I mean, just the
It's just worth noting that the unemployment claims that we just got are the lowest in 2 months. Not really like a huge drop over here, but you did give, you're trending in the right direction for not a recession. Now we may end up getting, another read later on, thanks to WARN notice data coming out soon. This report is out due today, and WARN notices are really this legal requirement. Heads up that a company is going to perform layoffs, and it applies to larger companies, not all companies. You have to have a certain number of employees. But I want you to see the chart for WARN notices. I find it very interesting because it somewhat aligns again with what we're feeling in markets right now. So the WARN notices chart, let's grab it here. There it is. Okay, WARN notices. Oh, come on, Mr. Computer. There we go. Okay, WARN notices right here. Take a look at this. This is, here, I'll hide myself for a moment. This is the WARN notices chart. And what you'll find is that we were getting a rise in WARN notices that indicated potentially trending towards a lot of unemployment and a recession. This was during the 2022 rejiggering where we're getting a lot of layoffs and claims for unemployment. As you can see, that's peaked. So let's go ahead and put an arrow there to make that quite clear for everyone. So there you go. You can see this is peaked, and we're going to get WARN notices again today. And we expect that if this trend continues, it would really align with actually a soft landing, that maybe we don't have to be so horribly concerned about this massive unemployment recession. And so this really does lead to the question of, okay, well, how do you position yourselves in stocks? This is something we've talked about. Robert, I see your question here. This is something we've been talking about, boy, for a while. It's obviously been quite entertaining because last year would have been positioning likely too early for many stocks. There were definitely arguments to be made about investing in about June and July for many stocks. Many stocks never hit another bottom, right? June, July of last year ended up aligning with peak inflation and potentially really being the peak Paul Volcker fear moment. Of course, we did get a second pretty large dip. Some stocks hit their actual bottoms in December. And so there was an argument to be made about really allocating between June, July, and December. But there was a chance that if you bought between that window, you were still upside down for a bit going into 2023, right? Most people have bought between July-ish and December, are probably up on their stocks now, given the rise that we've had in 2023. And this has led to this question of, okay, well, how do you allocate extra resources to this market? Mostly because the dips that we get seem to continue to be bought. And I think today will actually end up being a very good test for exactly this. Look, for example, at, or watch at least, what do we think Netflix and Tesla will end up doing today? So look, first of all, at what Netflix has done, basically, since their bottom. So here's their bottom, May, June, July. That was the bottom for Netflix. Netflix has essentially been straight up since then. You may as well call it straight up. The trend is pretty beautiful. You could draw a beautiful, sexy little trend line over here, and it could do better than that. There we go. Probably drag that over, something like this. That's pretty darn close to the trend that we've been getting over here in Netflix. And some kind of rejection of this trend line, which isn't even perfect, I can clean this up a little bit more, is not horribly unsurprising. And so down 6% here. The question now is, will Netflix end up falling below some of the supports they've been creating, whether that's 418 or 375 or even this 451 level? That's probably about where we're going to get our red line to right now, is the previous high might end up creating a support today. I wouldn't be surprised if it does. And that really would go to show as a test that this market is looking for any potential dip to just get back in the market, to allocate that leftover cash they have. I think the same will end up being true here at Tesla, where we're looking to drop it what looks like we're going to open probably around 279. Looks like we'll be kind of getting rejected off of the lines that we saw around June 21, June 22, or potentially even bouncing off of those. It depends how we end up opening. And if we bounce off of these, then that shows, okay, so we get a little bit of a dippy doodle after this remarkable uptrend, and it gets bought up right away. It wouldn't surprise me to see that over the next few days here. Now, we know the solar industry is still lagging under the weight of higher rates, and that's why Enphase has been sitting closer to that bottom compared to many other stocks that were actually in their bottoms last year. Enphase is really creating its bottom this year. And it so far looked like this little double W-shaped recovery over here at the bottom at your 23% Fibby line. And it might take until rates fall for Enphase and some of these solar stocks to really move. But that creates a potential opportunity to still allocate to a sector that's still softer than others. But I think watching movements on Tesla and Netflix today will really guide, okay, how do you have to behave in this market? And it seems to be that every dip ends up getting bought up relatively rapidly. I mean, look at Tesla over the year to date chart. You've had these dips that have lasted maybe a week. You had a dip in March, right around the banking crisis. You had a dip here in April around the banking crisis, each about a week. And you've just gone on to create a new high for the year. The same has been true for Netflix. And I don't think that this earnings report from either Netflix or Tesla was bad enough to suggest that we'd suddenly break this trend of dip buying. It's probably because allocations to these companies just aren't strong enough. And therefore, any of these dips are really just another opportunity to say, all right, well, let's take a little bit of cash out of bonds or just the cash pile and throw it into stocks. So what it feels like is, even though usually and statistically lump sum investing is the best way to invest, it's psychologically very difficult to say, I'm going to take all my bag right now, all my cash, and I'm going to throw it all into stocks. Because you could get a 6% negative day the next day and be like, damn, shouldn't have lump sum invested, right? Statistically, lump sum investing is what performs best, at least according to Vanguard's research. However, what could be psychologically easier is really just the DCA strategy at this point, where because the trend is so clear, buying a little bit at a time on a little bit of dips might be the best way to allocate that extra cash. Obviously, you have to evaluate your own personal financial situation to determine if that's right for you. But it seems to be the strategy right now, mostly because these dips just don't last. And that I find is so very interesting. So looking at, of course, some of the maybe catalysts we've got coming up. I mean, you've got the Fed meeting coming up as maybe a potential catalyst. Often what we see leading into the Fed meetings is a softening right before. It could be Monday or Tuesday. You get a little bit of a softening. You could get a softening before the GDP read. So to be clear about catalysts coming up, you've got the FOMC on the 26th. That is at 11 a.m. California time. And that night, so about 12 hours later, you've got the expiration of that beautiful, delicious, sexy coupon code. Email us at staff@meetkevin.com if you got any bundle up requests. As expected, we're almost completely sold out on your ability to shadow us as we look for real estate. Big discount if you're a course member. So check that out via the link down below. Just go to meetkevin.com or email us at staff@meetkevin.com. You've got, I'm looking at these catalysts here. They're relatively benign coming up. You've got some more home sale numbers, which we know what's going on with real estate. We've got Richmond Fed manufacturing expectations the day before the Fed meeting on the 26th, GDP maybe on the 27th. That could create some heart palpitations. Prior GDP read was 2%, now expecting 1.8%. You've got some, inventory numbers and capital goods numbers coming out next week. But really, biggest catalyst here is just going to continue to be earnings season. And so far, earnings season is just stacking up to be like, oh, it's not that bad. It's kind of the way I look at it. Not that bad. Let's look at some of the commentary y'all have here, or if anybody wants to chat in Twitter Spaces, feel free to hit a request. Car for Coin here says, wonder how high NVIDIA can go before a major correction. I think you really have to look at earnings to assume a correction for NVIDIA. But if they, Q2 is for Nvidia is really what's supposed to knock it out of the park. So you'd have to rely on weak guidance. So, weak guidance would show you that the AI bubble was maybe a hype-driven one. I don't know, though. We'll see. I mean, after Elon's discussion yesterday about how delicious and sexy those NVIDIA chips are, man, I don't know. I was pretty bullish on NVIDIA there. Let's see here. -6% is normal for for crypto. Yeah, that's true. Brandon says Tesla at 100 was wild. Yeah, no kidding. Brandon, we got to visit Arkansas again. We need that cash flow, man. Where's that cash flow? Which city's got the cash flow, man? Let's see here. So Robert hits on the psychology of averaging up on cost basis with DCA. It's really important to remember that cost basis is by far the stupidest thing that should exist in a brokerage account. There should be a switch that lets you disable cost basis. I'm a big fan of thinking about the psychology of money when we invest. And generally, if you only had $100 to invest, you never had more than $100, maybe cost basis makes sense. But since you probably are listening and you have a job and you're trying to build your wealth, or you're building your wealth with real estate, you're building your wealth with stocks, whatever, you're going to be allocating more money to your investments over time. Unfortunately, though, when people get this psychological belief in their head that, well, I bought Tesla once in 2017 and I have a $15 cost basis and I'm never going to allocate to it again because that would increase my cost basis. And what you're basically doing is you're saying, I don't believe in that company enough anymore to invest in it anymore, on one hand. And on the other hand, you're saying, I'm too much of a little bitch to increase my cost basis and allocate more money to a good company because it'll move this psychological goalpost that doesn't matter. It's really stupid. It's like a wiener measuring contest. It's so stupid. And if you have more money, you have to allocate where you think it's right to allocate. It's like, look, I first bought Enphase at $30. Am I not going to buy it at $180 if I think it's a fantastic company? No, of course not. Who cares about this whole basis thing? It's such garbage. But again, it's wiener measuring is what it is. All right. So let's see here. Do I think housing development is a good business to get into? I think obviously at this time it feels like a very good business to get into. With this lack of resale inventory, now would be a great time to have already been building, right? So if you already bought land a couple years ago and you were able to build and you had all your connections, yeah, I mean, I don't think you could argue that building right now is bad. Do I think it makes sense now to get into building? Probably not. Mostly because the amount of headache and architectural and engineering headache and finding the land that's not already overpricing in that, building's going to be great forever. It's going to be pretty difficult. I feel like you're going to pay a premium for land. And I don't know if that will continue in the event that rates do end up trending back down and we get more into balance. Building is also something that I'd be down to do it at some point, like long term in the future. But I look at it as almost like politics. It's like, we'll wait a little bit until the local city councils are like, yeah, Kevin, please build us something for us, and it's kind of like rather than them being with all their builder cronies. Now they're like, please, somebody build. I'll wait for that kind of an opportunity to get into building, not not this kind of level. So we're there seems to be plenty of building in the pipeline, rather, while at the same time people are desiring building. So you have high valuation and a lot of competition. It's kind of a weird mix that you have right now. Yeah. Anyway. All right. What else do we have here? Wheat rising as the U.S. warns of explosives at Ukrainian ports. You got, look at that jump we've got on the wheat ETF. WEAT ETF, the misspelling of wheat, but gets you down to 4 letters over here. You can see it's up at 721 right now. We were bobbing around a low of about 662 to 588. Nice little spike over here, as well as an increase in volume. Some of the pain here. Any comment on that jacket shirt combo though? This is a vest, my friend. New York City, bro. New York City Stock Exchange. Let's see here. Who knew it would call Kevin calling me a B, little B, to change my mind on cost basis. California, sorry, I find myself. Yep. Anyone want to talk on Twitter Spaces? Send in a request. Kevin, what do you think the new Tesla stock price prediction will be with FSD for other OEMs? You know, I'm actually a big fan of this OEM push for other OEMs using FSD, mostly because I think you could just start with autopilot. Like, you don't need full self-driving in the beta where you're turning on city streets or whatever. Just give the world autopilot, and it'll make the world so much of a safer space too. I think it'd be phenomenal. I would love to have autopilot in other vehicles. Like, you know, we might be in the market for a Mercedes Sprinter soon because we have too many children coming. And well, now we need the space. And I'm dreading the fact that it doesn't at least have autopilot. You know, it's like, oh, but it has adaptive cruise control. It's like, dude, no, it's not even close. Like, somebody should drive those side by side. And then you'll see they're not even close. And I think there's some good profit opportunity there. I mean, if Tesla can rake in, you know, either a recurring fee or, you know, a one-time $1,000 a car for autopilot or $2,000 a car or whatever for autopilot from these OEMs, boy, that's delicious. Saves billions of dollars in R&D for these legacy companies that aren't able to pull it off, and you know, provides such a massive utility to other vehicles that people would be likely willing to pay for, to where the OEMs likely end up winning anyway, and so do the customers. So let's see here. We got Hunter asking to speak on Twitter Spaces. Let's go ahead and add Hunter to the space, and let's see what Hunter has to say. I'll keep my finger on the mute button in case he's gonna start screaming. Nobody's done that yet. Everybody's been pretty respectful. So what's up, Hunter?
Hey, good morning, Kevin. Thanks for having me.
What's up, man?
I was just going to see if you thought there was a decent case for Tesla moving into a new sector at some point, not anytime soon, but into the prefab. So with your discovery that Boxable may or may not be as exciting as they say, the TAM of residential construction is about twice the TAM of the auto market. It's growing in a slightly larger CAGR. It's a big contributor to emissions, and it's just pretty inefficient where it stands right now. I think if they could do what they do with cars, have maybe 4 different models, it would help their Tesla solar roof deployment that they've had issues with scaling because it's just kind of hard to install, it seems like. But if they had 4 different models that they could just pump out the exact size of the solar roof, you have the Powerwall, and just a clean, enjoyable Tesla product that's a home. Everybody loves their Tesla cars. What do you spend more time in than a car? Is your home.
Yeah. Wow. really good point. I mean, you're right about that. I certainly spend more time in my home than I do my car. Look, you know, I think if anybody can pull it off well, Tesla could probably pull it off quite well in terms of some kind of Tesla manufactured home model. What's wild though is you actually do have manufactured homes today. It's just a company like Boxable that tried making really, really sexy. You know, you get these manufactured homes that you can place on permanent foundations. Like, take a look at this. Wholesale manufactured homes. Now, you could just go to their website here. And, you know, they have ads on their website here. I just saw one where it's like, get your home for, you know, $64,000 or whatever. And you jump in here. It looks, I mean, their advertising is kind of terrible. It looks a little spammy. But here's the, you know, these are mobiles, but you can throw them on a permanent foundation. It's basically the same thing, right? So you go in here and you pick what do you want? You want 900 square feet? You want 1,000 square feet? 1,200? Goes all the way up to like 1,500 square feet here. Pick your floor plan. all pre-done in a factory. They do your interior walls, your exterior walls, your kitchen, your bathrooms. They do everything for you. So the argument here is to say that manufactured homes have existed for a very long period of time, whether they're mobiles or they're permanently affixed to foundations. The boxable ones that would, in theory, be permanently affixed to foundations if they actually had permits to do anything that they promised to do, would basically just be sort of the sexy version of a mobile home that's attached to a permanent foundation. And so what I think is fascinating about that is that manufactured industry already there here 60, what is it, starting at, of course, $69,000, $69,995 for your first home. Let's go back to that slide there. Yeah, look at that. Don't pay retail, buy wholesale, browse floor plans, view current specials. I think it's fascinating. Yeah, look at that. Here's their $99,000 model, your $79,000 model, 124, 149. What do you want? We'll manufacture. There's their 69. You get a single wide for 69. So you have this manufactured model that already exists for housing. Yet for some reason, whether it's buyer appetite that doesn't like the whole appeal of a manufactured relative to a stick-built home, or it's just that when you finally actually move these things to place, they're not that much more expensive than what you could build on site. And once you actually permanently affix them to the foundation, who knows what it is? But for some reason, it just historically hasn't caught on. And so I do wonder, sure, could an entrant like Tesla change that? Maybe. But then is there that much profitability? Now, what really drove Boxable was this desire of, oh, well, you could build homes cheaper because maybe you're using less lumber. And that was true, especially during the pandemic. You had lumber prices. Actually, if the chart would function here, go out to any more than a year over here, it would show that lumber prices ran over 1,000 over here on the LBS chart. Right now, we're sitting somewhere at about 559, which is still elevated compared to the 470 lows over here, but nothing like what we saw during COVID. So some of those costs to build have come down as well. And then, could Tesla sell these solar roofs? Absolutely. What they'd probably do if they were to get into manufactured homes is just throw solar panels on, mostly because those are a fraction of the cost. I think a solar roof on even a manufactured home, you'd still probably be somewhere around 80 grand because you're basically a sealed sheet metal roof in smaller panels. Whereas the solar panel roofs, you throw on a regular roof for, $8 grand and then throw on panels for 10, you're all in for like 18 to 20K versus maybe 4X the cost for a solar roof. But either way, yeah, I mean, if anybody could do it in terms of manufacturing, I think it would be Tesla. But it is interesting that I wonder if it's not so much driven by manufacturing as it is driven by buyer demand. See, look at Tesla, for example. Tesla starts making the Roadster on the Lotus body and appeals to your car enthusiasts for that two-door sports car, but it's electric. And oh my gosh, it's faster. Then you get the EV hype movement, which was the perfect time to launch a Model 3, for example. Everybody's wanting to go green with EVs. It was really a perfect alignment of, hey, let's manufacture something better than others do and manufacture what people want. I don't know. I'm not convinced that people want manufactured homes. I'll come back to you here so you can add your commentary, but I think that's the big potential roadblocker. Do people want these manufactured homes? Go ahead.
Yeah, I agree. That's why I think, like you said, Tesla might be the one that can do it because beforehand, nobody wanted EVs. They're the ones who made them sexy, quote unquote. So manufactured housing, go ahead.
No. I mean, I think you're right. I think that's exactly it. Hey, what was it like? What comes first, the chicken or the egg? Did Tesla really take off because people got excited about EVs because of Tesla, or were people excited about EVs and they're like, "Oh, there's Tesla"? You're right. I mean, maybe Tesla was sort of a leader in that with their Lotus-bodied EV, and maybe they need to make take sort of the manufactured body of a double wide and Teslafy it, kind of like they did to the Lotus, to get some sex appeal going there. That would be very interesting. I wonder if that is something that I wonder how Elon would respond to something like that, whether it would be a priority on something like AI via an Optimus robot and scaling out the existing factories, or hey, is it worth a prototype? What I think is interesting is that Tesla has bought about every type of manufactured home that exists already. They bought, they bought a Boxable. They bought, and this idea about them buying a Boxable wasn't that the Boxable was the great product. They just basically looked at the manufactured market and they were like, let's get one of everything. And so they bought, maybe 10, 20 different manufactured home styles. And I wonder if part of that was Elon almost looking at these going, is this an industry we can disrupt as well? Wouldn't surprise me if you're kind of like buying up all of your competition or one product of each of your competition. Wouldn't surprise me if that thoughts went through his head. And I wonder if, much like what we discovered in the Boxable process, where it's not as desirable as it seems, I wonder if he had a similar realization and thought maybe a bigger problem to solve than it's worth, or who knows, maybe he's already thinking about it. I don't know. It's a good question, though. Go ahead if you had another comment there.
Yeah, I think I could be wrong. Tesla might have been buying them too, but I think it's mostly SpaceX that's been buying them down at Boca Chica.
Yeah, I should have said SpaceX. You're right. It wasn't Tesla. I'm conflating Elon here at his two different roles, but similar argument that Elon buying them, whether it's via Tesla or SpaceX, probably the thoughts running through his head. But you're right. Good correction.
Yeah. So I think a collab between SpaceX and Tesla would be super exciting, because at some point, if Tesla's mission comes to fruition, they will need to focus somewhat on some sort of habitats. So whether or not they're going to trust somebody else to do that, maybe they will. But at some point, SpaceX will need to focus on some sort of habitat. It might be interesting to start working on just building a team of people. So one of the huge things that Tesla and SpaceX has is just their ability to recruit top talent. So Tesla's kind of running out of markets to get into that have a big enough TAM to attract more people and to make a difference on their revenue statements. So this is one of the last, this is kind of the end of my argument, then I'll get off. But this is kind of one of the last big sectors that could make a drop in the bucket, so to say, and just another way to attract different types of top talent that can collaborate together and solve interesting problems.
Yeah, well, thank you for that, and thank you for joining this space here. I think that's actually also very interesting. I mean, you're right. I mean, at some point, if you want to go to Mars, you got to have some kind of habitat. I wonder if that habitat will look more like a bubble or a home. But you're right. Hey, if they can start getting into manufacturing some form of home, that would be really interesting. Maybe that is what's next. And in in the next 5 years, we'll be reviewing the floor plans of the Tesla casita. Very good. Thank you so much for that. Dr. Keith, why don't you jump in here, and then Car for Coin, let's hit you up after that. So let's see what you got. And then we got Tim over here as well. So let's go ahead and start. What do you got to say, Dr. Keith? You here?
Yes, I am. Good morning, Kevin. How the heck are you?
Hey, great. Thank you so much.
Cool. So I actually wanted to shift a little bit and talk a little bit about real estate. Is that cool?
Of course.
Okay, so I bought a home back in 2021 with the plan of like, okay, everybody buying homes, I'm going to renovate this and make some money, right? And so I got it at a decent price, but I hired all the wrong people and things took too long. And basically, when the renovation was done, the market had completely dropped down, right? So I was like, well, if I hold on, I'll hold on to this for a while, and then my ability to make the kind of money that I'm hoping in this thing will come back in a few years, right? So I'll just go ahead and rent it out. So, but now I'm in 1 month into having tenants, and I'm already sick of being a landlord, man. So I'm like, I don't want to handle this crap. I want to plan my exit strategy. So my exit strategy is this, and I kind of wanted to get your thoughts, not obviously not direct financial advice, but just get your thoughts on, well, I can wait this out and I got tenants for like the next couple of years or so, and then probably around 2025, what's projected to happen is that the cost for like the mortgages and stuff are supposed to be down to like around 4% and stuff again, right? So down there, and I'm like, if I hold out that long, it's probably going to be a better place for me to be able to get back and sell the thing and take profit again, and then move on. But I'm also like, well, do I really have to wait that long to do that? Or am I missing some other exit strategies besides just saying, just get out and take a loss and move on? That's kind of what's in my head. And that's what I wanted to share, and just wanted to get your thoughts.
Yeah, I mean, I think probably what I would personally consider doing in your situation is, especially if, look, landlording isn't for everyone. And certainly the first, 6 weeks of having a tenant are the biggest headache, because that's where the tenant gets in there and they find all the, little annoyances and defects, and they kind of test the waters to see like how accommodating are you versus how much you put back on them. So it's very normal in property management that the first few weeks are the most difficult, and that's what you're going through now. The something to consider is for most people, I recommend this, especially when you're starting out as a landlord, is hire a property manager and see how they operate in your market for the first 6 months to a year. Sign that year contract with a manager, and maybe consider taking over management if you want at some point in the future. Usually when you look at real estate as an investment, and most people mess this up, you have to look at all of the potential benefits of real estate, and not just potential benefits, the real benefits of real estate, rather than just what seems like that, okay, well, this is what I bought it for, this is what I'm in for, and here's sort of my monthly expenditure. And what I mean by that is you look at real estate as your opportunity to not only pay down your principal. Hold on, let's write down a little list here. There we go. So you're going to look at it from the point of view of principal pay down. How much you paying down on that loan every single month? A lot of us, we look at our statement and we kind of just look at that headline number of, okay, interest out, taxes out, insurance out, and principal out. But we're remembering that a principal pay down is essentially in at least the flat market like a forced savings account. And I don't think we're really expecting a massive sort of downturn in real estate pricing, to where not only in addition to this are you probably going to face some form of longer term appreciation. So when you bundle these together, usually real estate looks pretty desirable, along with the fact you're going to get some great tax benefits to help offset that principal pay down that your tenant is paying down for you. Right, you're writing off your taxes, insurance, maintenance, management, utilities, reserves. So you have a tax incentive to get a property manager to make your life easier. That's probably what I would be looking at, rather than, sort of getting frustrated with the tenant, which is very, very normal, especially at the beginning, and then feeling like you made a mistake on your renos. That's sunk cost, right? At this point, if you have a good quality tenant, you're not facing an eviction or whatever. You've got a good quality tenant. They've got some requests. Obviously take care of the ones that are reasonable, and you should be able to, even just by waiting another maybe 6 months, let that tenant settle in a little bit. It's usually what ends up happening. Maybe you could share a little bit more insight, and then we'll jump on over to Car for Coin here. But share me a little bit more.
Sure. So I probably should have let you know that I did hire a property manager. That was one of the things that I was just like, I do not want to be hands-on with this stuff my own, right? So at least that part's taken care of. And I mean, and it's bringing in a decent amount of money. At least the costs are covered for the place, so I'm not taking a hit in terms of that with the mortgage and stuff. But I think it's the fact that they're getting on my nerves with these requests. Like the thing I'm dealing with right now, and I don't know if you've dealt with this before. I have one of those security systems that I had installed, and they were going to be. I left it in there just because as part of like a value add, but they decided to unplug the thing because they said, well, we don't use it, and I'm just going, why? Why would you do such a thing? Like, this thing is there to help make sure like you're safe. Right. And so, I'm paying for this. I'm still paying for this thing, but it's not getting used. And then I'm just like, well, I'm starting to like get those other like vibes of, hey, did I make a mistake with letting these tenants move in here? Like all these things, and the kind of questions that go in your head where you're like, okay, it makes it hard to see the long end of like, okay, this is really bringing in income. This is covering my costs, that kind of thing. I'm rambling a bit. Let me stop there.
No, please. What jobs do they have? What's their credit? Tell me about them.
Well, there's 4 people who moved in. There's 4 people on the lease. 3 of them had jobs at the time. I think all 4 of them are now employed.
Roommates?
A couple of them are night shift. One is a nurse. The other are third shift something or other. I'm not entirely sure on that one.
Wait, so you're telling me you think they have jobs now and they're roommates?
Yes.
Well,
I see. I can't see
so
you on
first
screen,
of all,
but I feel like, what the devil did you do, Dr. Keith, coming on?
It's all right. It's all right. Okay. All right. Let me think about this. All right. So here's my thought. First of all, typically with tenants, it's not unusual that something that you think for your home is a benefit, a tenant does not give 2 craps about. So generally when we rent out a property, I look at my properties as like, what is the absolute bare minimum that could break that we could give the tenant? Now that sounds like, oh, this is something a landlord would say, but it's just because of that. You end up playing customer service or you get frustrated that they're not treating the property like you. They never will. So the alarm part, you got to kind of disconnect from that. That's sort of like, but it's my home, you got to disconnect from that. Like I remember renting out my my very first home and I had an induction cooktop, and we always knew that if we had tenants, we should have a gas cooktop because the tenants are just going to scratch up the induction cooktop. And I remember when we first rented out the property, we're like, well, no, they're going to scratch it up. And it really took like, do it. Scratch it up. It really took us like turning our head around and going, scratch up my cooktop, you jerks. And then the first tenant, sure enough, did. And then I'm like, yes, this is why you don't put stuff in a property that you know a tenant's going to break. And it was like the perfect lesson because it was just sort of what you needed to like get over that feeling of being a landlord. Because it's like, of course, they don't own it. They're not going to treat it that way. So it's like, that's totally normal. But as far as like renting to roommates, I'm glad you have a property manager, but you set yourself up for a little bit of a headache with this one. Now, it sounds like you're probably in a lease. So, transitioning this is whether it's for sale or for renting to somebody else, it's going to be a little challenging. But I'd say probably in the future, what you'd probably want to do is maybe take a little bit less rent, go for that single tenant where you have one tenant on a lease, whether it's, single person, a couple, whatever. It doesn't matter who it is. It's just one entity, right? And then that person or people have stable jobs, their credit scores, and you're not trying to sort of rent it out by the room because your management intensity is potentially going to go up, not down with that. So your frustrations will probably remain a little bit longer than in a normal rental. But let me put it this way. It will be the best learning that you do over the next year. So, write it off as a beautiful learning experience. But I don't know that I would yeet the property away because you're frustrated over it. Every time they call from now on, try this. You're going to go, thank you for calling and complaining. How can I help you? Like, don't say that, but think that to yourself. Like, thank you. It's learning. Thank you for coming on here.
Thank you for Tony Robbinsing my home health. Appreciate you, man.
Good luck
Chat
for you.
soon. Bye.
Yep. Car for Coin, why don't you hop on in here? What you got, man? Last time we talked crypto, what do you got today, man? There you go. Let's see, it looks like I got your speaker in. I'll bring
Hello?
Yeah, there we go. You're in.
Right,
Go ahead.
Can you hear me?
Yep.
Oh, okay. Thank you.
Welcome back.
Yeah, just I want to say that I did share a rental property with a man from the Army when I was in college. I took the right half, and he was the left tenant.
Nice.
All right, so Kevin, I just want to update your viewers and listeners a little bit on the SEC situation versus Ripple.
Yeah.
It looks like the judge did request a date for settlement. So I think that's the judge saying that let's not drag this out anymore. It's not looking good for the SEC, so you might want to settle. I looked into the SEC appeal chances, and the big risk for the SEC if they appeal and they lose, which is going to take probably 2-3 years anyway, is they're going to lose their grip on crypto as an unregistered security claim. So for them, it's a really high risk to do that. So it seems very unlikely. And the next catalyst that I'm seeing from this is Coinbase very likely to settle also with the SEC, or maybe even the case getting thrown out if that SEC thing gets wrapped up first with Ripple.
Yeah, I agree with you. I think what we've seen over the last few readouts and transcripts from some of these case docs between both Ripple and the SEC, and then SEC and Coinbase, the judges are just railing on the SEC. And I on one hand, you think like the SEC's just got to be overwhelmed with this. No guidance from Congress, and I'm not trying to make excuses for them, but it's a government agency, so they lack the funds. They don't have the coffers that a Coinbase does or a private institution, and they probably have a challenge retaining talent as well to some extent. I think you've got this tendency for people to start working at the SEC and gain experience, and then they go start their private practice, and they're able to advertise that they work for the SEC, right? So that's nothing to say anything bad about folks who end up wanting to stay at the SEC, but it is to say that they're probably well understaffed. And I think it really showed. Again, not making excuses. I'm just saying, like, it's actually great for the crypto industry. It's like, the big dog who's supposed to be the one that's like fighting crypto is really weak. And it's like, the emperor wears no clothes. Like these if just judges who aren't crypto experts are going, SEC, these cases aren't passing the sniff test, it's kind of embarrassing, I have to say. So I'm pretty proud of the whole crypto community on their behalf, because the SEC's arguments haven't been that great, and it's finally starting to come through with some commentary and rulings from judges. So I agree with you. It's definitely positive for crypto.
There's a great analogy. Bali, I think, is the guy who made that $1 million Bitcoin bet. He said that you respect the police if like 1 or 5% of your small town is considered like criminals, right? But then when the cop says you're all criminals, the town loses respect and the cop loses that power. So that's what the SEC did. They said everything's an unregistered security except Bitcoin. You're all fraudsters and scammers. He literally said that. So when that happens, initially when that happened, when he went after XRP in 2020, the SEC were like, okay, it's very centralized. It's Ripple. Coinbase delisted it. Okay, maybe they're criminal. Let's let this play out. But when he attacks everybody, when everybody's a criminal, then you lose that power, you lose that credibility. And now congressmen are writing letters, which I can send to you by email. They're saying, hey, the SEC is not doing their job. They're just attacking instead of providing guidelines. And even Gary's interview recently, he's pivoting to artificial intelligence. And I apologize if I made this point before, but now he's saying ChatGPT is evil, and he's using face scan on his phone to unlock it, and his evil twin unlocked it. Some weird stuff. It's pretty interesting, but it's fun how it's developing for a crypto bro like me. And I just want to let your listeners know that you have to be patient in this very volatile market. If you zoom out, like 80% of the time, Bitcoin does nothing. It goes flat in the bear market. So you have to be patient. And if you're waiting for lower prices, keep in mind, so is everybody else. When Bitcoin's at 15,000, everybody's waiting for 12,000. Bitcoin's at 69,000. I'm telling my dad to buy it for, it's going to go to 100,000. So
yeah, it's
really
true. And thanks for that. Yeah, I mean, it's you get this almost the same thing in stocks now. Everybody's waiting to put that floor under these stocks, and I think it's interesting what you say about Gary Gensler. We're going to jump over to another speaker here in just a moment. Thank you for that, Car for Coin. But yeah, the thing about Gary is I wonder if he's just distracted, honestly. Tim, I'm going to bring you on next. I mean, he goes on CNBC and says, "Oh, we don't need a digital currency. We already have the digital dollar." Essentially, is what he's arguing. I'm like, wait a minute, are you worried about securities or are you worried about the dollar? And now, yeah, you're right, Car for Coin. He's complaining about AI, dude. Gary, what are you doing? And part of me wonders, is Gary the right leader for the SEC? Because you have to look at it this way: when you have a leader who is so convinced that, here's the leader, and they're like, we are going straight for that target. That is the most profitable target. We're going for this. Maybe we'll attack it from multiple flanks, right? So we're going to have multiple strategies at attacking the same target. Then that might make sense. But and that gets the respect of your supporters. Whereas if you have a leader who's like, pulling off the digital dollar. Ooh, what's this AI thing? Ooh, what's going on over here? All of a sudden your staff are more like, which direction do we go in? So I do wonder if Gary is causing more confusion than he's actually helping the Security and Exchange Commission. So unfortunate for them. All right, Tim, what you got? We've only got a couple minutes left here before Course Member Live, but let's hear it, Tim. What you got?
Hey, I guess I had a comment about the manufactured home question from Hunter, and then maybe a question from me, and I'll try and make them real quick. The comments I had about manufactured homes is I wonder if people are more cautious about getting into manufactured homes because in some cases they can have higher insurance premiums, and people are kind of looking to keep that cost down, whether or not it really matters.
Yeah, I actually think that's a great point. Manufactured both on permanent foundation and not, you're generally looking at non-conforming real estate financing. So maybe that's actually where you have to start. You're not getting a 30-year fixed rate mortgage. You're getting your higher down payments, 20 to 25%. You're not getting those lower downs. You're getting lower terms, more variable style loans. That less FHA approval for these things, if at all. You might be right. It could be driven by financing and costs, including insurance, so both loan and insurance costs. You might be right about that. I think that's a really good add. What comes first? Is it the building, the desire, or the government incentive? A really good point. Thank you for that.
Cool. And also, thanks for letting me come on and speak here. It's great to get to talk to somebody I spend so much time watching on YouTube. I guess my main question is, I'm very fortunate to have a job where I have a salary and I get RSUs as well. And I do just fine on my salary. So my plan is to take the RSUs and invest them into real estate. And I was curious what your timeline is like when you get some kind of influx of cash, as far as whether you hold it in a bank account, maybe a high yield savings, or whether you invest it into something broad, just like an S&P 500 index fund while you're looking for the right property to buy. So I'm kind of struggling with, do I leave it in the bank or do I invest it until I find the property that I want?
Yeah, absolutely. Great question. So this will be the last question. And then tomorrow I see you here, Mikkel, Martin, and OMW. I'd love to invite you back tomorrow and we'll make sure to get you in. I'll remember you. So come on back tomorrow if you don't mind. So regarding that question, what do you do with your cash in the meantime? It depends on your horizon. One of the problems that I find people will make is they'll put the money into stocks, and then their effort to actually find deals goes to zero, right? So like your desire to find a deal literally drops off a cliff. And so the idea turns into, oh, well, I'm always looking for a deal. But you got to almost make finding deals your full-time job. And then all of a sudden you find more deals than you can even handle. And that gets really fun and entertaining. So I don't know that there's much of a difference if you put your money into Robinhood's 5% savings, so as long as you're not incentivized to just YOLO that all away on options, or a 6-month T-bill, or throwing the money into the S&P 500 or the NASDAQ. while you're looking. I don't know if it makes that terribly much of a difference. I think the biggest shift you'll get if you're talking about that investment capital is going to be how good of a deal you get. Because really, we're talking, a 20% down on a 500K home. We're talking 100K, 5% on cash yield for, say, 3 months while you're looking for a deal, or what stocks might do in that time frame. It could be up, could be down. It could create some risk, right? You get a 3-month down window at the same time as you find a good deal. Sometimes you get discouraged and you're like, crap, now I don't want to buy. So you get a little bit of everything. So anyway, thank you so much for that question. I got to run over the Course Member Live. It looks like I actually missed the bell answering that question.
Said about 40% increase. And this
Darn it.
says, listen, we are going to have more homes.
Congratulations, everyone. Market's open. Don't know that you can really go wrong with any of those. Wish you the best, but focus on finding that deal. The nominal differences of where you park the money for the next 3 months shouldn't make that much of a difference. I got to run. Thank you so much for being here. Jumping over to the Course Member live stream now, and we'll see y'all in the next one. Thank you, folks. Bye.